Currency Committee throughout the 1920s and into the Great Depression years of the 1930s, explained it this way.
The course of Russian history has indeed been greatly affected by the operations of international bankers. The Soviet government has been given United States Treasury funds by the Federal Reserve Board, acting through the Chase Bank. England has drawn money from us through the Federal Reserve banks and has relent it at high rates of interest to the Soviet government. The Dnipro Dam was built with funds unlawfully taken from the United States Treasury by the corrupt and dishonest Federal Reserve Board and the Federal Reserve banks.
In other words, the Fed and the Bank of England, at the behest of the international bankers who controlled them, were creating a monster, one which would fuel 7 decades of unprecedented communist revolution, warfare, and most importantly, debt.
In case you think there's some chance that the money changers got communism going and then lost control, in 1992, the Washington Times reported that Russian President Boris Yeltsin was upset that most of the incoming foreign aid was being siphoned off, quote, straight back into the coffers of Western banks in debt service, close quote.
No one in his right mind would claim that a war as large as World War I had a single cause. Wars are complex things with many causative factors. But on the other hand, it would also be equally foolish to ignore as a prime cause of World War I those who would profit the most from the war. The role of the money changers is no wild conspiracy theory. They had a motive, a short-ranged, self-serving motive, as well as a long-range political motive of advancing totalitarian governments, with the money changers maintaining the financial clout to control whatever politician might emerge as the leader. Next, we'll see what the money changers' ultimate political goal is for the world.
Shortly after World War I, the overall political agenda of the money changers began to be clear. Now that they controlled national economies individually, the next step was the ultimate form of consolidation, world government. The new world government proposal was given top priority at the Paris Peace Conference after World War I. It was called the League of Nations. But much to the surprise of Paul Warburg and Bernard Baruch, who attended the peace conference with President Wilson, the world was not yet ready to dissolve national boundaries. Nationalism still beats strong in the human breast. For example, Lord Curzon, the British Foreign Secretary, called the League of Nations a good joke, even though it was the stated policy of the British government to support it. To the humiliation of President Wilson, the U.S. Congress wouldn't ratify the League either. Despite the fact that it had been ratified by many other nations, without money flowing from the U.S. Treasury, the League died. After World War I, the American public had grown tired of the internationalist policies of Democrat Woodrow Wilson. In the presidential election of 1920, Republican Warren Harding won a landslide victory with over 60% of the vote. Harding was an ardent foe of both Bolshevism and the League of Nations. His election, which opened a 12-year run of Republican presidents in the White House, led to an unprecedented era of prosperity known as the Roaring Twenties. Despite the fact that the war had brought America a debt 10 times larger than its Civil War debt, still the American economy surged. Gold had poured into the country, and it continued to do so afterwards. In the early 1920s, the governor of this bank, the Federal Reserve Bank of New York, a man named Benjamin Strong, met frequently with the secretive and eccentric governor of the Bank of England, Montague Norman. Norman was determined to replace the gold England had lost to the U.S. during World War I and return the Bank of England to its former position of dominance in world finance. On top of that, rich with gold, the American economy might get out of control again, just like it had done after the Civil War. During the next 8 years, under the presidencies of Harding and Coolidge, the huge federal debt built up during World War I was cut by 38%, down to $16 billion. the greatest percentage drop in U.S. history. During the election of 1920, Warren Harding and Calvin Coolidge ran against James Cox, the governor of Ohio, and the little-known Franklin D. Roosevelt, who had previously risen to no higher post than President Wilson's Assistant Secretary of the Navy. After his inauguration, Harding moved quickly to formally kill the League of Nations. Then he quickly moved to reduce domestic taxes while raising tariffs to record heights. Now, this was a revenue policy of which most of the Founding Fathers would certainly have approved. His second year in office, Harding took ill on a train trip in the West and suddenly died. Although no autopsy was performed, the cause was said to be either pneumonia or food poisoning. When Coolidge took over, he continued Harding's domestic economic policy of high tariffs on imports while cutting income taxes. As a result, the economy grew at such a rate that net revenue still increased. Now that had to be stopped. So just as they'd done so frequently before, the money changers decided it was time to crash the American economy. The Federal Reserve began flooding the country with money. They increased the money supply by 62% during these years. Money was plentiful. This is why it was known as the Roaring Twenties. Before his death in 1919, former President Teddy Roosevelt warned the American people what was going on. As reported in the March 27, 1922 edition of the New York Times, Roosevelt said, "These international bankers and Rockefeller Standard Oil interests control the majority of newspapers and the columns of these papers to club into submission or drive out of public office officials who refuse to do the bidding of the powerful, corrupt cliques which compose the invisible government." Just one day before, in the New York Times, the mayor of New York, John Hylan, quoted Roosevelt and blasted those he saw as taking control of America, its political machinery, and its press. The warning of Theodore Roosevelt has much timeliness today, for the real menace of our republic is this invisible government which, like a giant octopus, sprawls its slimy length over city, state, and nation. It seizes in its long and powerful tentacles our executive officers, our legislative bodies, our schools, our courts, our newspapers, and every agency created for the public protection. To depart from mere generalizations, let me say that at the head of this octopus are the Rockefeller Standard Oil interest and a small group of powerful banking houses generally referred to as the international bankers. The little coterie of powerful international bankers virtually run the United States government for their own selfish purposes. They practically control both parties, write political platforms, make cat's paws of party leaders, use the leading men of private organizations, and resort to every device to place in nomination for high public office only such candidates as will be amenable to the dictates of corrupt big business. These international bankers and Rockefeller Standard Oil interests control the majority of newspapers and magazines in this country. Why didn't people listen to such strong warnings and demand that Congress reverse its 1913 passage of the Federal Reserve Act? Because remember, it was the 1920s. A steady increase in bank loans contributed to a rising market. In other words, just as it is today, in times of prosperity, no one wants to worry about economic issues. But there was a dark side to all this prosperity. Businesses expanded and became strung out on credit. Speculation in the booming stock market became rampant. Although everything looked rosy, it was a castle made of sand. When all was in readiness, in April of 1929, Paul Warburg, the father of the Federal Reserve, sent out a secret advisory warning his friends that a collapse and nationwide depression was certain. In August of 1929, the Fed began to tighten money. It is not a coincidence that the biographies of all the Wall Street giants of that era, John D. Rockefeller, J.P. Morgan, Joseph Kennedy, Bernard Baruch, etc., all marvel that they got out of the stock market just before the crash and put all their assets in cash or gold.
In